All right. Hey, everyone. Thanks for joining us. We are going to jump into what I think is going to be a lot of fun. We're going to talk about asset management. Asset management, after you buy the asset, then what do you do? That's really the question that we're going to dig into a little bit today. I'm Andrew Reichert, founder and CEO of Birgo. I've got Mike Neumayer. He is a asset management associate here at Birgo. And we were just talking about this. Mike, you interned with us. When was it?
Yeah, 2020, so right during COVID.
2020, you were at Pitt, held a Pitt,
Yep.
and then you went somewhere else that we will not name, and then you came back when?
Yeah, 2023, so just over 2 years been back, and it's been great.
Awesome, yeah, and you've been crushing it. Mike's been managing a bunch of our assets, about 2,000 units and about 200 million of AUM falls under Mike's purview. So I've got a question. I'm sure we've got folks that are joining us online that don't really know what asset management is. So in your own words, what would you say? Like, what is asset management?
Yeah, it's a lot of things. I think first and foremost, it's actually a people business. We have to get buy-in from so many people, both our internal property management teams, our investors that we're interfacing with, the lenders, really runs the whole gambit, both internal, external. And without that buy-in, it's hard to do anything, from behind the computer desk. So we really need that on-site team buy-in. But it really is just shepherding the asset through its investment horizon. So from acquisition to disposition, it includes, dealing with staffing issues and helping and enabling the property management team to work efficiently, but also making sure our returns are within that goal post for the investors that we've promised, and hopefully we're scoring touchdowns and not just kicking field goals.
Yeah.
That's our goal. But yeah, it's certainly just kind of being the eyes and ears to make sure at that higher level we're marching in the right direction towards exit and investor returns.
Yeah, awesome. Well, I love that you said it's a people business, because I think a lot of people think of asset management as like, a quant job, right? Like you're behind a computer, you're staring at spreadsheets all day, and you do some of that. And we're going to do some of that today.
We definitely do that.
But like to hear you say that it's a people business is really interesting. I feel like that's maybe not how external folks perceive the job. And so it sounds like you're saying people business. What do you think is like a real differentiator between good asset management versus, say, mediocre asset management?
Yeah, I think it really is all about that buy-in from the on-site team and for execution, because we can have all the right answers. We think we have, and we do have behind the desk, but unless it's getting enacted on and we're seeing those results at the asset level, it's not going to be helpful to really anyone in the process. So it is about that buy-in and that people aspect, and helping us help them help the property and the tenants.
Yeah, I love that. And that's really a good definition of our teamwork value, really working together with the folks to produce good results. So let's jump in. I asked you to pick a property.
Yeah.
It's probably hard to do. You manage a bunch of properties. But tell me about the property you picked. Why'd you pick it? And what are we going to kind of go through today?
Yeah, so we'll be looking at Pendel Towers. It's a 132-unit high-rise multifamily. It's in the heart of Mount Lebanon, so right within that central business district. And for those that don't know, Mount Lebanon's a suburb just like 15 minutes south of Pittsburgh. So still got that urban mix to it. It's a 1967 vintage property. It's housed in Birgo's Income Fund 2, and actually it really kind of acts as a good cash flowing anchor to that income fund, which we enjoy. We acquired it December 2020. The expected hold period is 5 to 7 years. So, we're coming up on that 5-year time horizon, but, we really like the asset, so we'll probably hold it that extra too. When we bought it, there was no real intricate business plan. We're not coming in here and saying it's value add and needs X, Y, and Z. There's no big repositioning. It's a solid cash flow asset that we really liked. It's producing income day one, and like I said, it was that good anchor. So we've been trying to improve efficiencies and identify opportunities to push those returns, but overall it's just a solid asset.
Yeah, awesome. So December 2020, we purchased it. You said you interned in 2020.
Yeah.
So that's so funny. Maybe you were like, hey, we should buy this asset.
I won't give myself
back
that
in
much
your-
credit. Yeah.
But we've had it now for 5 years. So like what are we looking at today? How's it performing? And we're going to talk a little bit today. We're just going to be transparent and honest with folks online. By the way, if you're online and you're watching this, go ahead and post any questions or comments in the chat. If you're on YouTube, LinkedIn, Facebook, you can post in the chat. We'll see those. We'll respond. But we're going to be super transparent and vulnerable about what's working, what's not working. But just the very high level, kind of what's happening at the asset today.
Yeah. So like I said, we're still the happy owner and hope to be for at least 2 more years.
Yep.
Overall, it's operating well. It's throwing off 9.5% cash flow margin, which is good when we're looking at this fund who aims to provide that 8% annual distribution to investors. It can do its piece there, and while also maintaining its own CapEx, turnovers, OpEx, all the sorts.
Mm-hmm.
But yeah, we're tackling issues day in and day out. Like we said, it's a good asset, efficient, and has opportunities, but that doesn't mean there's not hurdles and issues to deal with.
Yeah. Well, we'll talk about some of those. So why don't we just jump in? Well, first of all, 9.5% cash on cash in today's market is incredible.
Yeah.
I mean, assets aren't really doing that, especially for acquiring a 2020 vintage asset. I think honestly the past 5 years, it's been hard to find really solid cash flowing assets. Now, we're not going to talk about the acquisition side, but certainly the acquisition side did a good job sourcing, acquiring this asset.
Definitely.
But then since then, we've really optimized it, and let's talk about that. I thought it'd be good to jump into just kind of looking at T12. Is that what you were thinking in terms of starting place?
Yeah, I think that's a good idea.
Okay, great. So I'm going to pull this up. So we use this system called AppFolio. This is one of the reports. It's a pretty intricate system, but I just went in here, pulled up T12 income statement, filtered it by Pendale, and then T12. So this is just trailing 12 months modified accrual accounting basis, and this gives us kind of the full P&L. I know it's probably a little bit hard for the folks online with the small print, but why don't you just talk a little bit about the P&L?
Yeah, so like we said, cash flow is great. NOI margin's a bit less sexy. If you scroll down to NOI, we're actually at about a 41% NOI margin.
Yeah.
So we would definitely say that is on the low end of where we want to be.
Mm-hmm.
And that comes with some of these older buildings. That being said, based on its scale, 132 units in one building, we want to be pushing towards that 50% NOI margin at a minimum.
Mm-hmm.
So, we're working to do that, but it certainly, isn't a snap of the finger type
Just
deal.
before we move on, make sure folks online
Yeah.
are following. So net operating income is NOI. When you say NOI margin, you're talking about net operating income as a function of revenue.
Yes.
So revenue here, we've got rental income, we've got utility reimbursements, we've got other rental income. That gets down to kind of total operating income. You've got a little over $2 million in the trailing 12 months of total operating income. And then you kind of take out expenses, repairs, all that stuff. A little over $800K. That's
Right.
your 40% you're talking about.
Exactly.
Now, before we move on from that, I'm noticing a trend here, and I think it's generally a good trend if you're looking at trailing 12 months. You've got some months even, which is interesting because these are winter months, so I wouldn't expect such high NOI in winter months when leasing is maybe not as favorable, but maybe it's timing of taxes, or I don't know. What's your perspective on the trend of NOI and what's impacting it?
Yeah, so it can, property by property can definitely be a bit muddy at times. The one thing that kind of attributes that bumpiness in the expense side is the billing of utilities. So maybe this, and actually Mount Lebanon Township we've experienced does this, where they'll bill some of our bills quarterly. So there's 2 months of the year that are looking great, and then the third month is a bit downer. But when we average them, it's what we expect to see.
Yeah.
And we do our best to budget to that, bit of bumpiness and not that straight-lined month. Other things is that in the winter, our property management team worked really hard the past 2 years to correct our lease expiration schedule. So that's a big deal. Everyone likes their leases expiring from spring to end of summer Everyone likes moving in the in the better weather, and certainly in Pittsburgh, no one wants to be moving in January.
Yeah.
So that's why income's a bit steadier in the fall to winter months, is because we're kind of locked in on occupancy.
We're staggering leases.
Right. So maybe there's a few lease expirations, maybe there's an eviction here, an eviction there, but overall that occupancy is staying steady. As we move into spring, you'll get some of that bumpiness of maybe elevated vacancy, but then on the back end, as you get higher lease trade outs, which is the new lease versus the old lease, so rental increases and that stuff, you'll start seeing that come to fruition in the few months after.
Gotcha. That makes sense. When you're signing leases to stagger them, are you doing 18-month leases, 15-month leases, like basically whatever you can do to get it to not expire all in the same month kind of thing?
Yeah, exactly. And we let our property management team do that. They're pretty built out on the leasing front in terms of we have a director of leasing and revenue. So that's one of his main functions is to do just that and make sure we're offering. And if we're offering a longer term lease, that's a bigger commitment by the tenant. So maybe it comes with a month of free rent up front or prorated throughout the term. So it works for both of us. It takes two to tango.
Right. That makes a ton of sense. All right. Well, sorry, I derailed us a little bit on NOI, but that was helpful. Let's talk about, so you mentioned it, NOI margin at 40%. Not really where you want it to be. Not bad, but not perfect. What are some of the factors impacting it? If I'm going to just kind of go down through the P&L, what are you seeing that's impacting it?
Yes, first off, it could be an income problem, right? So maybe our denominator's too small. Maybe our expense load is fine and we just don't make enough income. For this asset, it's not the case. It averages 96% occupancy. It grows about 3% annually on income. So that's not the issue. So then it becomes, okay, what's wrong with the expense load? The expense load is high.
Yeah.
So if you're to go through, if you scroll down some to the utility section of the expenses.
Yeah. Gotcha.
So we have pretty meaty utility expenses. And that goes back to the age of the building, 1967. It's not overly efficient, certainly not LEED certified as the new builds are.
Right.
So for this particular one, our boilers are old and inefficient. So that's going to contribute to higher utilities. So, how do we offset that? Well, we could replace the boilers.
Right.
But that's a hefty CapEx project,
Right.
At this point in the hold period, probably doesn't make too much sense to have that kind of capital outlay.
Just to pause real quick. So boilers would show up as what? Gas,
and they'll have some water and sewer component to them too.
And sewer as well. Okay. So you're spending $100,000, really $100,000 a pop on gas, water, sewer, $150,000 a year on electricity. So big utility expenses for sure. Two things I want to go into. One, so if you're evaluating, hey, what's the cost of replacing the boilers and what would that do to NOI? I assume you have to think about utility reimbursements. And I think you're already doing some of that. Can you talk about utility reimbursements a little bit? And then two, I'm guessing you would have some calculus for, do you know, would it be a $300,000 project, and if so, how many year payoff? Right, I assume you're thinking that way.
Yeah, definitely. For the CapEx cost, I don't think I could speak confidently to that, but luckily we have an in-house construction management team that can speak confidently to that. So they would go
out, they'd get bids,
right? So I would engage with them and be
like,
hey, what we want to do this. What would it look like? They run that bidding process and they have expertise in that process. So we have confidence there that we'd be getting what we need. As far as utility reimbursements, right? So we have historically been on a flat rate billing fee. We're switching to, it's called a RUB, so Resident Utility Billback System, and that's bought out by Conservice, who's like a name brand in the space. They bill back tenants for their usage. And how does that work when you're not sub-metered? There's a variety of billing methods. It can be by bedroom, it can be by square footage. And we do square footage at this because we have a lot of different unit types. So we have the square footage for each one based on that unit type that percentage is then passed back to the tenants. So that helps us. That doesn't decrease our expense, but it increases our income and what we're recapturing. So that utility recapture rate. So
you still show it as an expense on the P&L,
Yep.
but then you show it as a reimbursement on the income side.
Right. And we're gonna go into the budget comparative in a bit, and we'll see 2025 year-to-date experience, or 2025 year-to-date versus 2024 of the same time period, and we'll see that utility reimbursement has increased.
Yeah.
That being said, right, we don't want to punish tenants living there that don't have a say over the age of our boilers.
Right.
So we've self-instituted caps on what those rates are going to be, and they're trying to mimic what these tenants have seen historically on the utility side, and then over time, that cap can increase as it ramps up.
Okay, gotcha.
So we recapture more of that utility burden. At the same time, it also typically encourages tenants to use less and be more mindful of consumption, because now they're on the hook for their actual usage, where before, they're paying $50 for water and they can use however much water they want.
Right.
So that also helps a bit in bringing down our expense side of things, is that consumption.
Yeah. And I would just add, it's probably good for the environment too, right?
Yes.
Some folks care about that, some don't, but anytime that you can align the incentive of the user with the cost, and therefore helping them to be incentivized to reduce usage, that's going to be a win-win for everybody. So as opposed to flat $50 a month, there's some calculus on their actual usage, and then it incentivizes them to use less. I think that makes a ton of sense.
Right. And then whenever we replace fixtures in any units across our portfolio, renovation, normal turn, whatever it may be, whenever it's needed, it's low flow. So, low flush toilets, sinks that don't, just guzzle water.
Right.
So that also helps too.
Yeah, that makes a lot of sense. Cool. You mentioned the budget comparative report.
Yeah.
Do you want to jump into that now, or is there anything else on the T12 that you want to look at here, talk about?
Yeah, let's scroll up a bit. So we go to sorry, not that far. Right around there. So that repairs and maintenance, the maintenance mechanical HVAC line item that you see, that is a bit of a backwards thinking line item. So we recognize and we accept that we have inefficient boilers. Doesn't mean we shouldn't do anything about it. So we have been going through this bidding process and engaging with vendors that are experts on these systems to figure out how to service them and have them run as efficiently as possible, right? So it's a bit of a reoccurring charge, an upfront charge, which is kind of counterintuitive when we're trying to skinny up expenses.
Right.
But we expect that on the back end then to help reduce that utility burden and consumption of that inefficiency. And plus, like I said earlier, utilities can be a bit lumpy and harder to project on cash flow, where if we have this recurring maintenance that helps bring down that consumption, we know when that's getting billed. It's getting billed quarterly. So that also helps project cash flows.
Yeah, that makes a ton of sense. Is that typical? Is that specific to this asset, or preventative maintenance? How do you think about that versus reactive?
Yeah, I think it depends. When it's this large of a CapEx project, and these boilers are serving the entire property, so 132 units plus all the common areas, that's when we're going to be proactive. If we have AC units that don't pose a real threat, right? If the AC unit's in the ceiling, when it stops working, it leaks and causes a flood. Well, if we know that those are old, we want to replace those actively. Otherwise, we're going to do it reactively. Yeah. And we have vendors in place, and we actually have in-house HVAC technician too, who gets to those repairs as fast as possible, because we don't want the tenants to be out of AC either. Right.
That makes sense. Cool. Makes sense. Anything else on the T12 you want to talk about?
No, I don't think so. I think we're good.
Okay. So you mentioned budget. So we started talking about utility reimbursements.
Yeah.
You mentioned the budget comparative report. So this is just, again, an AppFolio report filtered by Pendel Towers. We did January to June of this year versus January to June of last year.
Right.
So I assume June is the most recent books that we closed
exactly.
out. So this is basically first 6 months of the year versus first 6 months of last year. So good kind of time period to review. Can you talk about, you want to start with the utility piece, or where do you want to go here?
Yeah, I think we just take it from the top, really. So this is a report asset management lives in. Like I said, so on that left side, that actual period budget, that's the 2025 numbers. On the right side is the 2024 numbers. So you can slice and dice this report however you want. Sometimes I'll pull on the left-hand side the current month or last month or current month even. And then on the right side, I can pull year-to-date or the quarter it's in to see how we're stacking up. But this, we're going to review current performance versus last year.
Yep.
So if you look at, rental income, scroll down a little bit.
Well, before I scroll down, can you explain gross potential rent? And like, what does all this mean? Because, again, I don't want to assume folks online understand this.
Yeah, gross potential rent is just how much rent you can collect in a perfect world. If 100% occupied, you don't need concessions, no delinquency. It's that market rate for every unit. So it's just a sum of all that.
Got it.
Market loss to lease. So normally negative is actually positive here because we're beating our market rents. Nice. But it's just the delta versus your in-place rents versus that gross potential rent, that maximum achievable rent. Yeah. So it just accounts for that delta. Delinquency is just rents that are not collected. So tenants that haven't paid when they're supposed to pay. And then vacancy is just that units that are not occupied.
Yeah. Okay. Got it. And so not everybody does it this way. Some people just show rental income. We do it this way so that we understand what are the impacts underlying any revenue that is not fully collected, which could be any of these categories.
Yeah, it helps you, diagnose the issue for sure.
There's really three main categories. It's either we're not charging market rent, we have delinquencies, which means tenants aren't paying rent, or we have vacant units.
Yep.
Okay, great. Thank you. All right, tell me where you want me to go here.
All right, yeah, let's go. So total rental income, so we see 917 this year. If you scroll over to the 2024 number, sorry, over, not down.
Oh, sorry.
Yeah.
No, with this.
So 905. So we've modestly grown the rents, and we've had some. So we would like to see that grow a little more, but we've had some delay in getting units turns, which has caused vacancy, and that's kind of where it all interplays. When your vacancy is elevated, it's harder to push your rents because you're trying to find that balance of that supply and demand. Really, is all the name of the game.
Yep.
So we expect that those issues have been solved, and we have a great new maintenance team in place in the South Hills who have been really killing it over the past 2-3 months. So we expect this back half of the summer to really help us escalate back up to that 3% mark, like I mentioned earlier, where we want to be.
Yep.
But yeah, as you can see, they're growing, just not as fast as we would like it to.
Yep, makes sense.
So yeah, next, if you scroll down to that utility reimbursement section, so this is the area where you start seeing RUBS and Conservice, that utility bill back, come into play. So I think if you scroll down just one more line. Okay, so we're at just about 75K so far year to date. If you go over, we were at what, 60K?
60 last year.
So we're already 14K. I mean, what, annualize that? We're doing well for sure.
Yeah. So that's 30K of new revenue per year, based on the trend of the first 6 months of this year.
Correct. And over time, we would expect that to continue to increase as we, like I said, we have those caps on there to make sure we're not blitzing these tenants with charges they can't afford, and that the charges that they don't deserve either. But over time, that's going to continue to increase.
Yeah. So 30K over, what was it, $2 million a year of revenue or something like that. So you're basically bumping NOI margin 1.5 points or something by doing this.
Yeah,
and it really doesn't cost us anything, and like it has this aligned incentives perspective as well.
Yes.
Cool.
Yeah. So I mean, on the income front, I think that's it. If you go down to total income, what we're at, just shy of $1.1 million. Last year we were at. Yeah, so about 40K of increase.
Yep.
So good to see.
And it's almost it's the utility reimbursements and then the rental increases. Yep. So, okay. Cool. You want to talk about expenses?
Yeah. So I think, mostly the repairs and maintenance is a section to look at. So there's some more, I would say everything under operating expense is controllable, but some things are more controllable than others.
Yeah, right.
R&M being one of them. So that encompasses everything: repairs and maintenance at the building, but also our contract services, landscaping, cleaning, the HVAC, or not the HVAC, the boiler stuff we talked about earlier. That's all encompassed there, right? So that for the contract services, you get your best prices by bidding out annually.
Yeah.
We like to see 3 bids from various vendors, both new, old, existing relationships. We just like to, even if we have that preferred relationship, we want to make sure we're keeping them honest and getting the best rates overall.
Yeah.
And then repairs and maintenance obviously are, we have an in-house maintenance team, so that's what that labor maintenance line item is. And they handle all the repairs pretty much at the property. So if you see, we're at 125 this year, and I think that's actually just about in line with last year. Yeah, so actually a marginal decrease, which, yes, we like to see. Like we said, we're trying to skinny up that operating expense. So
especially since labor rates go up every year, obviously.
Yeah.
So any decrease in expenses is, really remarkable.
Yes.
Yeah, makes sense. Speaking of labor, how do we decide, or do we decide, if at a property it's going to be like in-house labor, do we have a person that does all the repairs versus vendoring it out?
Yeah, so it always starts with our in-house.
Okay.
And from there, they triage if, they know their expertise and their abilities, and if it's without of that, we also have a trades program in our internal labor, separate from maintenance, but they interact very closely, and that includes some highly skilled labor. So that HVAC technician, a plumber, we have a mason / roofer. So like they'll call them in first and have them bid it, because normally they beat the any vendor, because you're not getting upcharged really.
Right.
If they're too booked up or they can't do it, then we vendor it out.
Gotcha. Okay, that's helpful. Cool. Where else do you want to go?
Yeah, we'll skip turnovers for now. They're a bit muddy at this point in the year. Like I said, we had a bit of that lull and backlog in turning units, so I wouldn't say they're too accurate on what we expect the remainder of the year. Utilities right on budget.
Yep.
They're an increase over last year. As utilities increase year over year, and that's a certainty. Other than that, that's the big line items.
Yeah, tax is pretty straightforward. Insurance, pretty straightforward. We're actually under budget on insurance, which is interesting.
Yeah, so we have a great individual, Will Wallander. Shout out Will. Yeah. He's great at tax appeals. And also he led a whole insurance rebidding process last year and found the portfolio great savings. At this property alone, you can see it's $18,000 a month.
Awesome. Which is interesting because insurance costs, as everybody knows, have been going up. So that's really huge. Cool. Anything else that gets us down to NOI? Any other thoughts on the budget comparative?
No, I think we're good. Like I said, it's just a report we live in, and it really helps us make sure we're driving to budget, which is that quote unquote pre-approved plan for the year. Yeah. Obviously, there's deviations and adjustments that need to be made throughout the year and as we gain more knowledge. But again, back to those goalposts. The budget acts as the intermediate goalpost to that larger underwriting goalpost.
Yeah, that makes sense. Let's talk about, you said skip turnovers now, but let's talk about just CapEx and turnovers. What are the unit types of the properties? What are you doing in terms of upgrading them? Is there an upgrade plan? Can you talk about that a little bit?
Yeah, so like I said earlier, when we bought this, there was no major renovation plan, and really all the renovations we've done have been pretty opportunistic at this point. So there's 121 classic units and about 11 updated units. Yeah, if you go over here, scroll down a bit more. Nice marketing. Yeah, so this is the classic unit. Yeah, exactly. So pretty straightforward. That's standard. Photos. Yes, you'll see. Yeah. Bit of the older kitchens, but nice, clean, bright. And this building has great views because it's perched atop the hill. So it's an added positive. Yeah. But like I said, we have upgraded a handful of units and are getting a decent bit of premium on them. So if you want to flip over to that other tab, the upgraded units look great. So they have,
Oh wow, gotcha.
Yeah, so they're a bit a bit even more bright. They have the LVP in the kitchen, the dark cabinets with that contrast to the light. Yeah, so they're nice. So like I said, we have about 10, 11 of these right now.
What's the upgrade program that we do when we do these?
Yeah, so
flooring, you said, paint.
Yeah, cabinets, paint, new carpet.
Are the appliances new, or are they the same?
That's a case by case basis.
Okay.
For this asset, I would say it's most new.
Gotcha.
Yeah, and then the bathrooms typically get a new vanity. And that same kitchen LVP flooring.
Yep. Bathroom.
Yeah.
Okay.
It's like we said. So this isn't built into the business plan, and it's more that opportunistic and would be funded by the cash flow. So if we have extra cash flow and we want to, then it comes to determining, do we want to give it to the fund to continue to distribute, or do we think it's a better ROI to reinvest in some of these units and get higher premiums that are then going to drive the exit value on the back end, and generate premium returns.
So if I can just pause here for a second. So we've done 10 of them that way. There's 121 that are classic or kind of not upgraded. Have we done the math of, like, if we do the other 121, what's the additional value?
Yeah, we haven't done the math fully because we know we're not going to do.
Okay, gotcha. But just, I know you said, like, we're already 5 years into this. We've exited the next couple of years. But if we wanted to go another round of, like, holding another 5 years or something, or even just thinking about the next owner.
Right. So if we were to re-underwrite this, we would totally incorporate that. And I think it's achieving about $200 premium on those upgraded units. So, I mean, I'm not great at mental math, so I can't do all that.
So $200 a month, even if that's 12 months, you're $2,400 of extra revenue from that unit. If the upgrade plan costs 10 grand or something, you would say, okay, well, that clearly pays for itself over 5 years, but then you also get that valuation bump. Right. So it's going to be like a no-brainer.
Right. So you get the payback period, but then it's all about that value creation on the back end. That really is the kicker. Because
then NOI is going to be that much higher, and that's going to impact valuation.
Right, because that's and for those that don't know, real estate's pretty much traditionally valued on that NOI, that net operating income, divided by capitalization rate.
Yep.
Gets you to your value. So it's pretty much industry standard.
Yeah. Okay.
Yeah, but then, so aside from that, we have some other CapEx projects that we're excited about. So first, we're doing the facade work, and that's more preventative maintenance and making sure we're keeping the asset safe and sound, and making sure our investors safe and sound, our tenants' units are watertight, all that good stuff.
Yeah.
So
the front elevation facade.
Yeah, exactly. Like it's with the bricks and such.
Yeah. Okay.
Again, I leave that to our construction management team to guide us there.
Yep.
So I'm no expert on that.
I know a little bit about the project. I think it's just this this old, like, concrete block facade is just a little dated. There's some bricks in the corners that are a little dated. These masonry buildings, I mean, this thing's gonna be standing way longer than you and I live, but it probably just needs a little TLC and pointing and some block work. So that's kind of the project there, if I understand it correctly.
Yeah, with a little bit of upkeep, they do their thing, and you don't have to worry about them.
Yeah.
But other than that, some more exciting community features and amenities. So we actually just installed a rooftop deck. So we've had the rooftop space there, and it's been underutilized, I would say, as we held this asset. So we just went through and made sure to make this an actual amenity space. So it has the new dining set, lounge sets, the electric grills. And actually, this is a great example of when asset management got really excited and property management was like, wait a minute, because we were looking at, like, propane grills and gas grills. But
right.
That's not. They made the good point.
Not safe.
The township might not allow that.
Right.
And they don't. So we went the electric grill route. We updated the lobby, as you see. So that's nice. Gosh, that first impression when you walk into the building.
I wish I had the before picture to show folks, but it was very dated looking. Yeah. This looks awesome.
It was original to the 1967 build, I think.
Yeah. No, this looks so good.
And then additionally, I mean, we're looking to add the possibility of adding a gym. So we have these commercial spaces on the first floor. So it's helpful that they're on the first floor because it's a good space right off the lobby to have an amenity space. These were previously occupied. We had some tenants move out, some tenants downsize. So there's like 3, quote unquote units. One of them is occupied. The other one is combined now into one. So it was 2 units combined into one. It's now just a down space, dark space. It's not being utilized for anything right now.
Yeah, this is this right here, right? This
exactly.
Like so like a hair salon or
yeah,
something.
So it still is, right? So that hair salon's still occupying that space, but to the immediate right of that is where that amenity space could be.
Yep.
So we could put another commercial tenant in there. Based on our hair salon rate, it's probably about $15,000 in annual income. So definitely nothing to sneeze at. But it'll also include us funding some what we call TI allowance, tenant improvement allowance, to help them build out their space and move in and make it nice for them.
Yeah.
The other thing is, well, what if we amenitize this property even further? So it has secure parking. It is centrally located and walkable. It is secure, has the rooftop deck, has some other outdoor areas. It has some other like community features too. Like there's a small library, a little community room. So the sense of community at Pendale is certainly unique in our portfolio, and like it's strong here. Yeah. So we're looking at the possibility of adding a gym to this space, and the rationale is we don't think many other buildings can offer all of this in Mount Lebanon on a walkable street in central business district to Mount Lebanon. Additionally, from an income side, like we think it would probably provide a $25 lift minimum across all units just on market rate.
Yeah.
So kind of improving that GPR as we talked about earlier.
Yeah, for sure.
Just because we become a product that's not readily available.
Right.
There's other assets in the market that are newer build that have those amenities, but they're further south. So it's a bit of a different, suburban feel than what you're getting in Mount Lebanon. Yep. So I wouldn't necessarily say that people looking at, Mount Lebanon are going to be looking at further south of that.
Right. That makes sense.
Yeah. So if we were able to achieve that $25 premium, that's going to generate $37,500 a year across all the units. Build out, we probably would estimate about $80K. So payback period's 3 years, but we only have 2 years left on the hold. So okay, well maybe that's not a good idea. Yeah. But no, it actually is. And why is that? It's because of that value creation we talked about earlier. That extra $37,500, most of, if not all of it's getting down to that NOI line item. There's not too much associated costs. Our cleaning contract might increase a couple of bucks. Electricities might increase a couple of bucks there. It's not all that much because the space is still being heated. There's still electric, right? It's still in the building. It's still part of its operations. Right. It's just not generating revenue right now. So if you take that $37,500 on NOI, capitalize it by that 7%, so using that cap rate, you're now looking at $500K in additional value on the backside, in addition to the 70-something additional revenue that you generated during your whole period. So like when we're reviewing it this way, that 2-year ROI, that's not so great. It's great, but the whole the payback period's not there. Well, now that becomes like a 7 times ROI, and it seems like a no-brainer to me. Yeah.
So you put $80K in, you get $500K out when you go to sell it. And playing the long game and being able to be focused on value and long-term value creation makes sense. And again, it's another win-win. Like the residents now get a fitness center.
Exactly. Certainly. And I think that, this is kind of where asset management becomes way more of an art than a science. Yeah. And, we're switching from that minutia day to day. We're in the P&Ls to, okay, well, how do we drive value and investor returns? Yeah. And of course, this only works if we get a premium or else we're just shelling out money. Right. So, how do we ensure we get that? We've done thorough market research on all of our competitors. Also, just like in general, looking at Mount Lebanon, there's gyms, but there's not an overabundance of gyms. It's not like a readily accessible where you have a Planet Fitness, a Lifetime Fitness, 3 CrossFit studios. Like it's not actually there. So we do think that demand is there, and there's not much of it for anywhere for it to go. Yeah. that's speaking on the external side of things. If we look at internal, we have 132 residents we can go ask.
Right.
And we're going to do just that. So we're going to,
Yeah.
we're going to inform them about our rooftop deck, get them excited, make sure they know that's a provided amenity now.
Yep.
Our team over there, property management team and the maintenance team, is actually having a cookout for them on Labor Day.
Oh, cool.
Yeah, so that's good. At the same
Ask some
time,
questions then.
yeah, we're ask questions then, but we're also going to put that in newsletters. So we're like, hey, is this an amenity you want? Is there other amenities you would like to see here, or that you value more? So we'll get all that data in before we make that final decision on a no go versus no go.
Yep. No, I love that. I think in the data, actually asking the residents, like, hey, do you want this? I feel like so few people probably do that, and then they, build something out, and residents don't use it, and it's like they could have just asked some questions, done some market research on the front end. So that makes a lot of sense. Cool. Anything else on the CapEx, turnovers? Anything else you want to share on that?
I think we're good. I mean, going back to that construction management team that Birgo has, they're handling these. So again, we're able to rely on their expertise, and we built out that expertise in-house, which is great.
Yeah, awesome. Well, let's kind of take a step back. I mean, we talked a lot about Pendale specifically. Mm-hmm. We've talked a little bit about asset management in general, but can you just maybe tell me a little bit more about like what's your day-to-day? I mean, you're obviously doing all of this stuff, but what are you thinking in terms of like, how do you really understand the market, and what else goes into kind of your job?
Yeah, I mean, that's what I really like about asset management is there's a ton to do at all times, and it's all different things, right? So other parts is and crucial to like understanding the market of where these assets are. Mm-hmm. Because at the end of the day, housing's a need and a commodity. So and it's a product. So if you're not selling the right product, you're not gonna get rent. Right. So we track our competitors and market demographics pretty closely. Mm-hmm. Update our rent surveys and whatnot, and then all of our assets go through an in-depth valuation process once a year. Mm-hmm. So that includes in-house analysis, the use of AI, which I know you're probably a fan
AI
of.
Guy.
And we also engage many local brokers who we have good relationships with to get BOVs, which is a broker opinion of value, kind of that third-party opinion of value. Okay. And we congregate all that and then make sure we're tracking internally where we think our assets are worth.
Yeah, I love it. And I'm a big fan of AI, obviously, but I think honestly the way you guys are using it and the way we're using it as a company, I honestly think it's cutting edge. We're starting to really lean into machine learning, predictive analytics, really leveraging generative AI and tools that are already out there to help us make better informed mm-hmm. decisions. And so I think your team is crushing it on that front. Anything else in terms of like just kind of the day job that you feel like is worth noting?
Yeah, I mean, back to the people front, it's very much of a relationship management job as much as it's asset management job. So we touch every aspect of the business internally and externally. Mm-hmm. We plug in with most stakeholders, if not all. So we're routinely interacting with the property management team, construction team, acquisitions, investor relations. So literally the entire shop. Yeah. And then externally, the department works, we're fostering relationships with our lenders, loan servicers, mm-hmm. Community organizations. Yeah. It's definitely a big one.
A little bit of everybody.
Yeah, external counsel, back to the brokers who are providing BOV, also just have like a wealth of market knowledge and know what's going on. And then we also own, for some of our larger investors, whether that be JV, just individual large investors, mm-hmm. we own that point of contact and relationship throughout the investment process. That we provide monthly performance packages to them and narrative and explain where their investments are headed.
Mm-hmm. Yeah, makes sense. Yeah, I think the people side is important. Just real quick, I think this will be probably the last thing we do, but can we talk a little bit about the tools you use? Specifically, there's this asset performance dashboard, I think. Did we build this? I'm guessing we built this.
We did build this, yes.
Can you just talk about this and how you use it?
So I inherited this, so I'm definitely grateful for the people that built it before me. So on this tab, so like the budget comparison summary. So this functions similarly to that budget comparative report we were in mm-hmm, earlier. Mm-hmm. It's a bit more stagnant because you can't slice and dice the time frames as much. Mm-hmm. but it allows us to kind of dive in deeper in that time frame.
Yeah.
So like for this example,
It's
budget
basically
comparative
shows
summary.
Current month, basically like the most recent month we
Yeah.
closed out. This is a property group, which is the property group that Pendale is in,
Right,
South
Pendle's in
Hills.
South Hills. Yeah, so if you scroll down on this one, so we have a per unit analysis. So that's helpful to see where we're at. But then if you scroll even further over, we have a benchmark built into this. So this benchmark, it's hard to get data for Class B and C properties. Class A properties, very readily available because it's all that real institutional kind of quality grade. This, it's a bit harder because you're relying on some mom and pops, you're relying on some people that just aren't operating efficiently and don't report or don't have advertising or, you know. So that's why you have to take these benchmarks with a bit of grain of salt, right? So that income benchmark, you know, it looks like we're well under income here. But when we look at our competitive set for the property, we're well in line with our competitors there. So that's where you have to dive in. But it's a good starting spot. You know, it's definitely not like set in stone or like.
It's kind of a litmus test.
Yeah,
like
exactly.
Where are we? How are we doing? You know, compared to the benchmark, the market, that kind of.
Yeah, and it's a quick hitter analysis, right? So it helps us tell us where we should put our attention.
Yeah, that's helpful. Makes sense.
Yeah, and then if you go to we have a metrics tab.
Okay.
If you scroll over.
Metrics.
Yeah, so this metrics tab can do a lot. So right now it's pulled for Pendale, so we can see year to date net absorption was -5. Like I said earlier, vacancy has been a little bit of an issue. This is showing us just that.
Yeah.
And that's because we've had that lull in unit turnover. Gotten that straightened out, so we're on the up and up there. And if you scroll down more to that in-place rent and market rent section, remember I said that our lost lease was actually positive? Well, that's because our in-place rents are beating our market rents, right?
Wow.
So part of that is just because, you know, we're getting really good renewal rates and tenant retention.
Formula. Good Lord.
Yeah.
Sorry.
That's why I'm grateful someone else built that and not me.
It's quite the formula.
Yeah.
Right, sorry, continue.
So on renewal rates, we're not pushing market rates too high yet because, like I said, we want to focus on getting vacancy back under that, like towards that 5% mark.
So maybe there's like a little bit of a push and pull. Like we pushed for a while, we get the rents up, but then vacancy comes down a little bit, and now it's the time to
it's constant
let it
dance.
settle. Yeah. I like that constant dance.
Yeah. So this has like metrics like T12 cap rate if we were to sell. Cost per turn $1,700. So that's because, right, so that seems, some people are gonna be like, wow, that seems high. Well, these units are very big. I mean, some of these 3-bed penthouses are like the size of a ranch house.
Right.
And new carpet, I mean, that you're at that mark already.
Yeah.
And new carpet's needed pretty routinely. So yeah, we use that, and then we have this watch list that we're building out. We did have it working for a little bit. We changed some of our accounting mapping internally, so we haven't updated this yet to reflect that. So it's on the shelf for right now.
Yeah.
So this watch list, right? It's gonna help us tell where we should be spending our attention. So it has all these inputs. So we want to look at rent growth. We want to look at controllable OpEx. So we collections, economic occupancy. So economic occupancy is vacancy plus 2+ month delinquency. So people that, you know, are probably going to get evicted and can't make their payments that are going to end up vacant. So it's kind of a bit of a both and a leading metric. And then leading with the plus 60-day retention. So how many of the individuals that are up for renewal are going to stay with us and renew their lease. We have days to turn completion, work orders, right? Because work orders is, again, leading indicator. If we have 30 work orders, we would expect, you know, a high R&M expense to hit that month.
Yeah, gotcha.
So all of these hit they're scored basically. So opposite of golf, the higher the score, the worse it's performing. And we have a trigger of if it's over 10, if it hits 10 points, it'll be on the quote unquote watch list. And at that point, we're triaging it and figuring out why, diving with the regional managers, and putting action plans in place to get it off the watch list.
Yeah, that makes sense. Yeah. Can we talk about, so debt service coverage ratio? I did want to dive into the loan piece a little bit. That's obviously something that we focus on a lot. And I know we have a different system that we use for tracking loans. Can you just talk a little bit about this system and kind of how you use it?
Yeah. So, I mean, Loan Boss is pretty powerful loan abstraction software, and I would say it's much more than just abstracting the loans. So we actually have, this loads up.
Is Pendel the right one to jump into?
Yeah, it's fine. So this has everything we need to know about our loan. So if you hit that show details on the, that guy right there. Yep. So again, they put all the complicated loan docs that we don't want to read.
Right.
Maybe we have read, but when I'm trying to get information I don't want to dive into, they put it all in a very digestible dashboard that we can click into. And then if we have questions on something, on how accurate it is, or make sure, we can hit that blue little page that is
this thing
here. Yeah, and it'll take you to the section of the loan doc that shows you, hey, this is, so then you can really dive in if you need to.
Interesting.
But what I like most about Loan Boss, if you go back to the main page, you go to the reporting tab up top. So this has everything we need to know about our debt, right? So it's very important. So P&I payments, so principal and interest payments, so that can give us a summary, what's interest only, what's amortizing that principal and interest, how much are all the monthly payments.
Yep.
We have, recourse, so that's good to know for our principals, what's recourse, what's non-recourse. We have a built-in SREO, so schedule of real estate owned. Just gives us a snapshot of everything we own, what vehicle, some information about it.
So you're using this to kind of just manage the debt picture in its entirety.
Exactly. And then, I mean, the biggest benefit here is the compliance reporting, right?
Yeah.
So compliance reporting is no one's favorite, but it's very crucial to make sure we're staying in compliance with our lender.
Banks reach out. They say, hey, we need your financials from the prior year. This tells us.
Yeah, so I actually get alerts in my inbox on, 5 days before something's due. Like, hey, send this over to them.
Yeah, awesome.
And then, you can come in here to double check what's annually, what's monthly, what's due quarterly.
Right. That's all this stuff.
And it's all of our properties. So, it's a nice little platform.
Awesome. Love it. Well, we're just about out of time here. This was great. Yeah. I learned a ton. Any kind of concluding comments? I mean, I guess maybe just give me your conclusion on the asset. Like, we talked about a ton of stuff. We talked about the P&L, comparative budget, CapEx, turnovers. We went through the asset performance dashboard, talked about the loan and the balances. Like, what's kind of your all-in conclusion on the asset?
Yeah. I mean, Pendel's killing it.
It's a good asset.
Yeah, it's a great asset. It's one, we're working through to make it more efficient, but we're never worried about it.
Yeah.
It's an asset that I wouldn't be surprised if Birgo finds a way to move it to new vehicles and new investments and hold on to it as like a Birgo forever asset, because it's that good. And it has so much potential still left in it. Mount Lebanon's a great area. If you've ever been there, Yeah. So, we're very excited and pleased with its performance thus far.
Yeah, awesome. Anybody online, if you have questions, comments, you can post them now. And I really like what you did here, Mike. Great overview of kind of your job, how you think about asset performance, asset management, optimizing the asset, really looking at both the revenue and the expense side of the P&L. So I appreciate you kind of running through this with me. Thanks everyone online for joining in. Hopefully this was helpful for you, and we're here if you have any questions. So thanks everyone.
All right, certainly. Thanks, guys.